Imagine you're walking down the street and you see a cigar butt in the gutter. It's nasty, it's soggy, it's been stepped on. Most people would, cross the street to avoid it. But a certain type of investor stops, picks it up, and checks to see if there's one last free puff left in it.
The classic Benjamin Graham cigar butt strategy, buying something that's been discarded just because it's cheap enough to offer that tiny bit of value.
Exactly. Now, imagine a company that just posted a 90% revenue drop, is burning over $1 million in cash every single day, and has negative earnings, as far as the eye can see. Sounds like the ultimate cigar butt, right? A dead asset walking.
On the surface, absolutely. I mean, if you just glanced at the income statement, you'd assume it's a company on its deathbed.
But here's the twist. What if I told you that same company is sitting on nearly $700 million in cold, hard cash, has almost zero debt, and owns what might be the Google Maps of biology? A map so valuable that NVIDIA is betting its healthcare future on it. And right now, as of today, January 17, 2026, the market is pricing it at just $4.67 a share.
And that, right there, is the paradox we're wrestling with today. Is the market pricing this company as if it's dead because it is dead? Or is this the sale of the century?
Welcome to the deep dive. I'm excited about this one because we are stripping away all the buzzwords. We hear AI and biotech smashed together constantly, but our mission today is to find out, is the industrialization of biology actually working? Or is it just the world's most expensive science fair project?
It really is the trillion-dollar question. And to answer it, we are focusing on Recursion Pharmaceuticals, ticker RXRX.
But not the Recursion of last year. We're looking at the new entity. They went through this massive merger with Exscientia back in late 2024, and now in early 2026, we're finally seeing what this Frankenstein monster actually looks like.
A violent metamorphosis, as the report we're using calls it.
I love that phrase.
Yeah.
And yeah, we're basing this deep dive on the RXRX trending report from a senior biotechnology equity strategist. It's dated just today, January 17, 2026.
It's a fascinating read because it takes a very sober kind of value investor look at a very, very hype-driven industry.
Before we jump into the wet labs and the supercomputers, just a quick reminder to like and subscribe to Stock Analytics AI. You really don't want to miss these breakdowns. Okay, let's get into the structure of this beast. Part 1. Chapters 1 to 3. Business, Management, and Financials. Chapter 1. Business Understanding. So we have to start with a problem. Why do we even need industrialized biology? What was wrong with the old way? I mean, the pharmaceutical industry has been around for a century making pills that save lives. Why fix what isn't broken?
Well, the thing is, it kind of is broken. The old way, the artisanal way, was essentially a guessing game. Think of the 20th century model as lock and key.
Lock and key.
Yeah. Scientists would find a target, say, a protein involved in a disease, and they'd spend years trying to design a molecule that fits into it perfectly, like a key into a lock.
Okay, that sounds logical enough. Identify the lock, cut the key.
It is logical, but it's also incredibly reductionist, because biology isn't a single lock. It's this massive, chaotic, shifting network. So you'd spend, a decade making a key, only to find out that unlocking that one door causes the entire building to collapse somewhere else.
Side effects.
Terrible side effects. And this leads to something called Eroom's law.
Eroom's law.
It's Moore's law spelled backward. You know how in tech, chips get cheaper and faster every year?
Right, Moore's law.
Well, in drug discovery, despite all our better technology, finding a new drug has actually become more expensive and less efficient over time. It's maybe the only industry where technology has seemingly made things worse, financially speaking.
That is actually really depressing when you think about it.
Yeah.
So Recursion comes along and says, what? Stop guessing. Let's just decode the whole thing.
Exactly. That's the TechBio convergence. Instead of a hypothesis-driven approach, they use a data-driven one. They take literally millions of pictures of cells reacting to different chemicals and genetic edits. They treat biology like a decoding problem, not a biology problem.
But here's where it gets really interesting for us today. The Recursion of 2026 isn't just the company that takes the pictures anymore. They merged with Exscientia. The report calls this a unified engine. How does that change the business?
Think of it as two halves of a brain finally connecting. Before the merger, Recursion was incredible at scaled biology. They had the wet labs, the robots in Salt Lake City. They could tell you where to go. They were, in essence, the map. They could identify the target.
Okay, so they point to the destination. Dig here for gold.
Right. But knowing the destination doesn't mean you have a shovel or a drill or a vehicle to get there. Recursion wasn't great at the precision chemistry, the actual design of the drug molecule to hit that target safely. That was Exscientia's superpower. They were the designers.
So Recursion finds the target, and Exscientia builds the bullet.
Precisely. The merger removed the bottleneck that existed between finding a target and making a drug. Now, in theory, they have a complete end-to-end machine. The Recursion OS identifies the target, and the Exscientia engine designs the molecule.
That sounds incredible on paper, but we need to see how this actually makes money. The report breaks this down into 3 pillars of value.
Right.
Let's unpack the first one, the internal pipeline. This is the high-risk, high-reward stuff.
This is the pure biotech part of the business. They own these drugs 100%. If they work, they keep all the profit. The lead horse here is a drug called REC-4881.
This is for FAP, right? Familial adenomatous polyposis.
Correct. And it is a brutal genetic disorder. You get hundreds, sometimes thousands of polyps in your colon. The cancer risk is basically 100%. The only real treatment right now is surgically removing your colon.
Yikes. And REC-4881 is, what, a cancer drug they repurposed?
It is, and this is a key validation point for their whole platform. This wasn't a brand new molecule they dreamed up. It was a known MEK inhibitor. But the Recursion platform looked at all the data and predicted, hey, this cancer drug will work on this very specific, rare genetic stomach issue.
And did it.
The data from the Tupelo trial seems to back it up. It showed a 75% reduction in polyp burden.
75%,
Yeah.
That's massive.
It's statistically huge. It suggests the map actually works. And financially, this could be a $500 million revenue opportunity. Since it's an orphan disease, they can charge a premium because there are simply no other options.
Okay, so that's the lead horse, a potential home run. What about the other one people talk about?
Hmm.
REC-994.
That's for cerebral cavernous malformation, or CCM, a rare brain vascular disease. This one is a bit more complicated.
How so?
The data was what the report calls mixed. The safety profile was good, and the MRI scans showed physical improvements in the structure of the vessels. But, and this is a big but, it wasn't statistically significant on symptoms yet.
And patients don't care about their MRI scans. They care about their symptoms.
Exactly, and neither does the FDA, usually. So while REC-4881 looks like a really solid bet, REC-994 is still in a gray area. It highlights that even with all this AI, biology is still really, really tricky.
Okay, let's move to the second pillar, the strategic partnerships.
Right. If the pipeline is their lottery ticket, the partnerships are the rent money. This is how they survive, without having to dilute shareholders to death. They have massive deals with Roche, Genentech, and Bayer.
And these aren't just, press releases, right? There's real cash moving.
Yes, and that's critical. The report highlights a specific $30 million milestone payment from Roche in Q3 of 2025. That's a huge validator. It means Roche isn't just signed up. They are getting data from the platform that is valuable enough for them to write a very big check.
It's like Roche is renting the Recursion map to find their own treasure.
Exactly. It's effectively outsourced R&D. And then there's the third pillar, which is maybe the most futuristic, data licensing. This is the NVIDIA partnership.
The BioNemo platform.
Right. This is their SaaS model, monetizing the map itself. NVIDIA invested $50 million back in 2023, and now Recursion is providing the data fuel for what NVIDIA calls sovereign AI in healthcare, and they have 50 petabytes of proprietary data.
50 petabytes. I can't even wrap my head around a number that big.
It's an ocean of data, a literal ocean. And in the age of AI, data is the new oil. If they can successfully license access to that data, they truly become the Google Maps of biology. Everyone has to pay them just to navigate the landscape.
So we have the pipeline, the partners, and the platform. But a machine this complex needs a serious operator. That brings us to the people running the show.
Okay.
Chapter 2, Management Evaluation. Okay, so big changes at the top. The founder, Chris Gibson, moved to chairman. And we have a new CEO, Najat Khan. What does a move like that signal to you?
This is the classic founder versus executor transition. Chris Gibson is a visionary. He's the 0 to 1 guy who built the culture, raised the money, and convinced the world that biology could be code. But taking a company from a science project to a commercial pharmaceutical giant, that requires a very different toolkit.
And Najat Khan has that toolkit.
She certainly seems to. Her resume is impressive. She came from Janssen, which is Johnson & Johnson. She was their chief data science officer. She lives right at the intersection of deep science and big pharma bureaucracy.
So she knows how the big dogs eat. She knows how to get things done in that world.
Exactly. Her hiring is a very, very bullish signal that the board believes the science experiment phase is over. You don't bring in a heavy hitter from J&J just to run more experiments. You hire her to get drugs approved and sold. It's a clear shift toward commercialization.
But there's a cultural risk here, right? Mergers are always messy. You've got Recursion in Salt Lake City, that whole biohive culture, and then you have Exscientia in Oxford, England. That's a lot of miles and a lot of cultural difference.
It is a huge difference. Salt Lake is very tech-forward, nimble, almost has a Silicon Valley feel. Oxford is steeped in academic, scientific tradition. The risk in any biotech M&A is always losing what they call tacit knowledge.
The tacit knowledge.
It's the stuff that isn't written down in the manuals, the intuition of the chemists, the specific way a team collaborates on a problem. If the best scientists get annoyed by new corporate overlords or the cultural clash, they leave. And that critical knowledge just walks out the door with them.
So how are they trying to handle that? Is it just a takeover?
It doesn't seem to be. They seem aware of it. They put Ben Taylor, who was the Exscientia CFO, in charge of the money for the combined company, and another Exscientia board member, Franziska Michor, joined the main board.
So it's not a conquest. It's being framed as a marriage of equals.
That seems to be the goal, yes. Retaining that talent from Oxford is absolutely critical. They need those chemists to feel like they are part of the future, not just victims of a merger.
Okay, let's talk about the money. Because looking at the income statement, well, it's a bit of a horror show. Chapter 3, Financial Health. The report calls it a sea of red. Q3 2025 revenue dropped to $5.2 million, just $5 million, down from $26.1 million the prior year. And they lost $162 million in the same quarter.
It's ugly if you just look at the P&L. I mean, they were spending about $23 to make $1 of revenue right now.
$23 to make one. I'm no accountant, but that sounds bad.
It's completely unsustainable in the long run, obviously. But you have to understand why the revenue dropped. It's because of the lumpy nature of milestone payments. Yeah. If they hit a big milestone for Roche in Q2, they get a huge check and revenue spikes. If they're doing the work in Q3 but haven't hit the next milestone yet, the revenue can look like almost zero. It doesn't mean the business stopped, it just means the check hasn't cleared yet.
Okay, fair point. But that burn rate is still intense. The report says $325 million in operating cash burn for the first 9 months of 2025. That's over $1 million a day, essentially, going up in smoke.
It is, but, and this is a really big but, you have to look at the balance sheet, this is where the survival story lives. As of September 30, 2025, they had $667.1 million in cash.
That is a massive war chest.
It is. And maybe more importantly, they have negligible debt, just $11.9 million. In a world where the U.S. 10-year Treasury is sitting at 4.23%, carrying debt is expensive. It's an anchor. Recursion doesn't have that anchor around its neck.
So they have the cash to keep the lights on for a while.
For now. Management guidance says they have a runway through the end of 2027. That gives them about 8 quarters to make something significant happen before they have to go back to the market for more money.
And they're banking on synergies from the merger to help extend that runway, right?
Nice. They're targeting $100 million in annual savings.
And synergies, in corporate speak, usually means firing people.
Unfortunately, yes. It's role elimination, vendor consolidation. We've already seen some of the announcements. It's the painful part of any merger.
So the metric to watch, really, is that burn rate in the next few quarterly reports.
Absolutely. If we get to the Q1 or Q2 2026 filings, and the burn hasn't dropped below, say, $150 million a quarter, then that 2027 runway guidance is, well, let's just call it optimistic. They have to prove they can cut the fat without cutting the muscle.
Okay, we've covered the machine and the fuel. But before we look at what the market thinks of all this, I want to talk about how you can do this kind of deep dive yourself. Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai.
For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker, and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC risk scanner, which detects red flags in company filings before they hit the headlines, plus our portfolio diversification analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust. Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment. Okay, we're back. Let's talk about how the world actually sees Recursion. Because right now, there's a pretty big divide. The stock is at $4.67. But JP Morgan has a price target of $11. That's more than double where it is today.
That gap, that huge gap, represents the black box skepticism. There's this fundamental doubt, especially in the more traditional scientific community. Is this AI platform finding better drugs, or is it just finding them differently?
This goes back to the repurposing criticism.
Exactly. Critics look at REC-4881, that FAP drug we discussed, and they say, great, you found a new use for an old cancer drug. That's clever. That's a neat trick. But can you design a brand new molecule from scratch that works better than anything else?
And have they proven that yet?
They haven't proven de novo design in a completed phase 3 trial. Not yet. And until they do, the market is pricing in that execution risk. The market is saying, show me, don't just tell me.
But then you have the NVIDIA factor. I mean, NVIDIA didn't just invest $50 million for charity. They see Recursion as a deeply strategic asset.
The report calls this a call option on the future value of data.
Okay, explain that for the non-finance listeners. What's a call option in this context?
It basically means you're making a relatively small bet now for the possibility of a massive payoff later. NVIDIA sees Recursion as the essential data layer for its healthcare ambitions. If sovereign AI in healthcare becomes real, if nations and massive corporations start building their own bio-AIs, well, Recursion is the fuel provider. They own the oil.
So on one hand, you have the science skeptics saying, show me the drugs, and on the other, you have tech visionaries saying, look at the data.
And the share price is stuck right in the middle, leaning heavily toward the skeptics right now. The consensus target is around $7, which suggests the broader market is cautious, but still sees some upside from $4.67.
It really feels like a battle between the old guard of biotech and the new guard of tech.
That is exactly what it is, and you can see that battle reflected in who actually owns the stock.
Chapter 5, Ownership Structure. Let's look at who is actually holding the bag here. We've seen some insiders selling recently, late 2025, early 2026. Lots of Form 4 filings showing executives selling off shares. Is the leadership jumping ship?
It looks scary on the surface, but you have to look a little closer. The report suggests this is likely just tax coverage for RSU's restricted stock unit.
Ah, the tax man cometh.
Always. When executives get stock as part of their compensation, it counts as income. They often have to sell a big chunk of it immediately just to pay the IRS. It creates headwinds on the stock price. Sure, it's selling pressure, but it's not necessarily a dump or a signal of no confidence in the company.
So it's not a vote of no confidence, it's just paying a very large tax bill.
More than likely. But contrast that with the whale buyer in the stock, ARK Invest, Cathie Wood.
She owns over 33 million shares.
It's a massive position, one of their largest institutional holders. And it highlights the philosophical divide perfectly. Warren Buffett, the ultimate value guy, would look at Recursion's lack of earnings and run for the hills. Cathie Wood, the ultimate disruption and growth investor, looks at the TechBio thesis and doubles down. She's betting that the convergence of AI and biology is simply inevitable.
She's betting on the moat. Let's talk about that moat for a second. Does Recursion actually have a durable advantage?
Well, they claim to have a data network effect, a learning loop. The idea is that every time they run an experiment, the data feeds the AI gets smarter, and the next experiment is better and cheaper.
So the 10,000th drug they discover should be fundamentally cheaper to find than the 10th was.
Theoretically, yes, and that's an economic advantage traditional pharma just doesn't have. But the real moat, in my opinion, is the physical infrastructure, the scale moat.
The robots.
The robots, yes. You can copy algorithms. 2 smart kids in a garage can write code, but you cannot code a wet lab into existence. Recursion has factory-scale robotics running millions of experiments a week. A competitor like in silico medicine might have great AI, but they don't have that proprietary data generation engine at scale. They have to rely on public data.
And public biological data is notoriously messy. Recursion's data is AI-ready from the ground up because they built it that way.
Exactly. And on top of that, there are switching costs. Once a partner like Roche integrates Recursion's map into their R&D workflow, it's really hard to stop using it. It becomes part of their corporate DNA.
Okay, we've talked a lot about the upside. Now we have to look at the cliff edge. What kills this company? Chapter 6, Risk Assessment. The report lists the dilution spiral as a mathematical certainty if things don't change.
This is the single biggest risk for the shareholder. They burn about $400 million a year. If the stock price stays low, let's say in this $4 or $5 range raising, that money becomes very, very expensive for existing owners. To raise $400 million, they would have to issue nearly 100 million new shares.
That would dilute existing shareholders by, what, 25 or 30%? Your slice of the pie gets way smaller?
And they have an ATM facility and at-the-market offering. It allows them to just drip feed new shares into the market whenever they need to raise cash. It keeps the lights on, but it also creates this constant low-level selling pressure. It keeps a lid on the stock price.
Then there's the binary risk. The big one, clinical failure.
Biotech is cruel. REC 4881 could look fantastic in phase 2 and then fail completely in phase 3 for some unexpected reason. If that happens, the whole blockbuster thesis dies overnight. The stock would likely re-rate down to just its cash value, maybe $2 or $3 a share.
And we saw a hint of this with REC 994, that brain disease drug.
Right. The data was mixed, good safety, the MRI scans looked better, but it wasn't statistically significant on symptoms. And the FDA cares about symptoms. If patients don't feel better, the drug doesn't get approved. That ambiguity is a huge risk.
And finally, there's macrogravity, the broader economy, interest rates.
Yes, the 10-year Treasury at 4.23% is a killer for what we call long-duration assets.
Long-duration assets.
It just means a company whose profits are far out in the future. Recursion isn't making money today. They're promising massive profits in, say, 2030. When you discount those future profits back to what they're worth today using a high interest rate, they're worth a lot less.
So high interest rates make the future less valuable in today's money.
Exactly. If inflation spikes and rates go up to 5% or 6%, Recursion's valuation gets crushed mathematically. Even if the science is working perfectly, it's just gravity.
Chapter 7, conclusion. So here we are. The stock is at $4.67 a share. The company has a market cap of $2.47 billion. Is it a trap or is it a steal?
Well, let's look at some of the parts valuation. I think it's pretty illuminating. First, they have roughly $667 million in cash.
Okay, cash is king. That's a solid floor.
And look at the partnerships. They have up to $20 billion in potential milestone payments. Now, you have to apply a massive haircut to that because most drugs fail. Let's be conservative and say only 5% to 10% of that ever materializes. That's still $1 billion to $2 billion in real value.
So cash plus a risk-adjusted value for the partnerships.
Yeah.
You're getting to roughly $2.5 billion.
Which is exactly where the market cap is today.
Wait a minute. So you're saying the market is pricing the company as just its cash and its partners?
Yeah. Effectively, yes. That implies that you, the investor, are getting the entire internal pipeline, including REC 4881 with its $500 million potential, and the entire Recursion OS platform, all 50 petabytes of that data for free.
That is the free option.
That is the core of the value investor's argument. It's an asymmetric bet. The downside is somewhat protected by the hard assets, the cash, and the signed partnership deals. The upside is, well, it's almost infinite if the platform actually works as advertised.
But Warren Buffett would still pass on this.
Oh, Buffett would pass in a heartbeat. There are no earnings. He doesn't buy lottery tickets. But a Benjamin Graham or a Philip Fisher, they might look at this as a kind of net-net style deep value play. There's a margin of safety provided by the assets.
So 2026 is really the year of truth. What are the catalysts we should be watching for?
A few key things. We need regulatory clarity on REC 4881. Are they going to move to a pivotal trial? We absolutely need proof of those synergies. Did they actually save that $100 million? And we need to see new deals signed via the NVIDIA BioNeMo platform to prove the software model actually works.
So if you believe biology will eventually be industrialized, the price today reflects the market's fear of the cash burn, not the potential value of what's being built.
That is a perfect way to put it.
You know, we usually think of biology as this wet, messy, chaotic thing, something you can't really control. But if Recursion is right, biology is just code waiting to be debugged. And they are the ones building the debugger.
It's a very compelling thought.
That's all for today's deep dive. Make sure to like and subscribe to Stock Analytics AI. Disclaimer, this content involves AI-based research and is not financial advice. Please do your own due diligence. We'll see you next time.